All right, welcome everybody. This is John Rothe at Riverbend Investment Management. Welcome to my Big Picture Weekly Market Update. This is for the week of November 4th, 2022. So let's take a look at what's been going on this week. Really, the big driver in the market has been the FOMC statement. The Fed had their meeting this week, and a lot of investors were hoping to see some type of language in here in their statement that would indicate that the Fed is maybe getting a little bit looser with their future targets, that they were possibly taking their foot off the brake a little bit, while their foot's obviously pushed down on the brake right now. Just people were hoping that maybe they lifted a little bit and they wouldn't be as aggressive going forward. And that's what the market interpreted from this statement that was added in here. And the market rallied fairly well. It started to rally right after the statement was released. And part of the reason is a lot of investors and a lot of the world is looking at this idea that something in the financial systems or the currency system is potentially on the verge of breaking. And whether that is a currency issue or whether the bond market starts to seize up, this was a worry. And we started to see other central banks overseas start to take action to intervene a little bit, whether it was intervening with currency like Japan did, or like what Canada did, where they didn't raise rates as aggressively as they expected. So this is what the investors were hoping to hear from the Fed, and that's what they heard from in their statement. They were very happy to hear this news. However, afterwards, Fed Chair Jerome Powell came out with his press conference and had very different remarks that spooked investors a little bit, and the market sold off fairly aggressively afterwards. And the two big takeaways from that press conference are highlighted here, basically saying that they're suggesting that the terminal rate, so basically if they're going from point A to point B, that end target rate is going to be higher than expected, and that basically they're going to stay the course until the job is done, meaning that we could have interest rate hikes for a longer period of time down the road. The other thing is that they've mentioned in here is basically this comment he made where he talked about the risk of doing too little or much higher than doing too much. So basically saying if they over tighten and the economy collapses, they have tools to fix that. Whereas if inflation lingers, it seems like they don't have that many tools to handle with other than rate hikes. So that this is an indication that, hey, we're going to aggressively raise rates. And if the economy goes into some type of deep recession, we have tools to support that and fix that later on. So the market took these two statements to be rather negative, and the markets pulled back fairly aggressively as well. And we saw that in kind of the Fed terminal rates here, for example. Before the meeting, the marketplace seemed to indicate and think that end terminal rate, that point in B we're talking about for the Fed, was going to be around 5%. Then the press release came out and people got excited and said, okay, the Fed's not going to be as aggressive. Maybe they're going to loosen up a little bit. Maybe they're going to pivot. They're going to end the rate hike cycle a little bit earlier than anticipated. Then we had the press conference, and look what happened. That end terminal rate started to rise in the market, and now this higher number needed to get priced in. That's why we saw stocks pull back so aggressively, because this was unexpected, and now the market needs to price in this idea of a higher end terminal rate, and basically this idea that the Fed is going to raise rates for a longer period of time. So basically the takeaway from the statement and then the press conference was that it looks like the Fed is potentially going to raise rates maybe in smaller increments. So instead of 0.75%, it's 0.5% going forward, but they're going to do so for a much longer period of time. So the market again needs to digest that and figure out how to interpret that in their models and how they want to push forward with that going forward. Looking at the S&P 500, we saw this pullback here that occurred right as the meeting occurred, and it pulled back fairly aggressively. Beforehand, it looked like the market wanted to rally. It was favoring this idea of maybe a year-end rally, and we started to see broader participation in the market. We saw momentum starting to improve. We were above this 38.2% retracement level, which was an important level, and we were looking to possibly rise up here and start to test these levels and maybe even break through that as if the year-end rally was strong enough. But now we're starting to test this resistance level here, this support level in the market, and we're going to see if the market can bounce from here. Hopefully it can, and that would be a good indication that the market is still maybe favoring a little bit of a year-end rally, that they think that the market's a little too oversold at this level and that they want to participate in any type of year-end rally that we might have. The other thing that we've been watching is this relationship between growth and value. Growth stocks have been outperforming value stocks significantly over the last few years. And what this line here represents is the relationship between growth and value stocks. As the line rises and as this trend rises, it means that growth stocks are outperforming value stocks. And as the line falls, it means that value stocks are outperforming growth stocks. We started to see this little trend be tested, this little trend that was rising here even earlier in the year. This relationship came down to this level where a lot of investors took that as a meaning that, hey, it's time to start looking at growth stocks again. And we saw a bit of a summer rally where it favored growth stocks and technology names. Well, now this relationship is breaking down fairly aggressively, and we're seeing value names really be favored over growth names, especially those leadership tech names like Facebook is way down, Amazon is way down. We're seeing those former leadership names start to break down as investors really don't want to own them right now. They want to own these value stocks. And this is where it seems like they see the opportunities within the value names. If we look at market strength, where's the strength been over the last 10 days? Well, it's been value. Same thing that's been happening week after week is the value names have been leading the market. Energy obviously has been a great performer. We're seeing industrial names, material names start to pick up. Healthcare starting to pick up as well. All value names. We look down here, this is our technology sector, communication sector. Communication sector is where you have a lot of social media companies in there. And you can see this is breaking down. It's still just really no positive strength, not really much of any momentum up to the upside right now. And people are ignoring these names. They're taking any opportunity and a rise in these sectors to sell them and to invest in value names right now. So again, that trend seems to be favoring the value names as of now. We look at our sector rotation. We see the same thing. It's confirming that indication that the value names are taking the leadership area. If you remember, these typically rotate in a clockwise fashion. This upper right-hand quadrant is our leading quadrant. This is our strongest areas of the market. Down here, these are our weakest areas of the market. So we always want to be up here investing in areas that are rotating into strength. And we can see here, energy is still strong. We're starting to see value names like financials, healthcare, industrials, materials start to pop up and move toward this area where, look down here, technology, communications, they keep getting weaker and weaker and weaker. So again, growth stocks are really kind of becoming out of phase, and we're starting to see value names kick in, and the market seems to be more interested in those value names as of now. The other thing to think about that we've been watching the last couple of weeks is this idea of seasonality. Seasonality is when you basically have these historical trends come into play. We can look at historical charts and see what the averages are over time. And typically, historically, have some type of year-end rally. It doesn't happen every year, but it happens enough that there is a positive trend that favors the idea of some type of year-end rally in the market. And it seemed like that was starting to occur, that we're starting to see a broadening momentum across the market, and that more and more investors were coming back into the market, and that idea of a year-end rally would seem to be on the table here. And this was all, of course, before the FOMC meeting this week. And now we have to see how the market handles that. Does the market still expect or anticipate a year-end rally? Or are they worried about what the Fed's going to do in this idea of a much longer time frame for Fed hikes going into the future? So we'll have to give it a couple days to see how the market reprices itself and how it absorbs this information going forward to see if this idea of any type of seasonal trend will continue or not. The other trend to keep an eye on is this idea of this presidential election cycle. Again, the first two cycles, the midterm, especially where you have midterms, tend to be the weakest, which is what we're seeing right now. Once we get past the elections, the midterm elections, the market tends to historically rally. It doesn't happen every cycle, but again, it happens enough that it's something to pay attention to. And what typically happens is you get closer and closer to that presidential cycle. During this period of time, everybody's out campaigning, talking about what's broken in the systems and how to fix it. And that's what gets investors excited, because their ideas get put on the table to fix whatever problems there are in the economy or in the world, for example. And investors get excited about that. And we see typically, again, fairly strong rallies as we get closer and closer to that presidential election. And before the FOMC meeting, it seemed like those trends were starting to occur and that the investors were starting to participate in this idea of some type of year-end rally. So the big takeaway is we really want to keep an eye on the market for the next couple of days to see how they absorb this new information, how they interpret this idea that, hey, the Fed is probably going to raise rates for a longer period of time, but maybe in smaller increments than expected, and how that's going to impact the economy and how that's going to impact some of these names going forward. So that's it for this week. Again, if you have any questions or concerns, you want to reach out to me, the best way is by email at john.rothe@riverbendinvestments.com. If you're on Twitter, you can check me out at John Rothe, where I post more daily charts and kind of more detailed information as well. So that's it for this week. Hope everyone's doing well and that you are starting to enjoy this cooler weather that we're having out there. So bye-bye for now.